Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Trent, welcome to the Australian Investors Podcast.
No, thanks for having me on. Really appreciate it.
Yeah, it's always good to join an investor that's interested in technology, that has a bit of a science and maths background in particular. I think is great. We're going to talk about qualitative, meeting quantitative investing, global companies and the like. To start off today's episode, though, I would love to know about one company. You've been doing this a long time. So about one company that you didn't buy, but you wish you did.
Yeah, and that's always a really interesting question, Owen. And there's one that, always troubles me a bit, and it's ServiceNow, actually. So, quite interesting business. I think it all comes apart from my wife. She runs IT teams. And so, she's much smarter than me. Of course, I'm always asking her, what are the applications that she's seeing and where she sees real value from these applications across her organization. And ServiceNow were doing the typical land and expand into her business probably about, 5 years ago. The interesting thing is, it's such a valuable application for businesses in terms of controlling that process flow, starting in IT with that service management, when you lodge a ticket, who it goes to, how it gets fixed, then expands into other use cases such as HR. And you can see it going pretty much into any business application where there is a process flow at the back. And so that was one that, started digging into probably about 5 years ago, did some really heavy work on it back in 2022, so not that long ago. But when all of the froth started to fall out of these software businesses, and I just struggled to get there on a couple of key metrics. First of all, valuation did feel a little bit stretched at the time, but then also the CEO had a bit of a history in SAP where they'd done a whole lot of M&A. It hadn't quite gone to plan. So there was a little bit of reluctance there, but that is one that, the use cases are phenomenal. The stock at the time when I was doing detailed work was about 380. It's now above 900, and the CEO has actually done quite a fantastic job. So that's always one that really sticks in the craw in terms of I didn't buy it. Maybe it's not too late. We'll continue to do the work, but I think there's a couple of lessons that come out of that. That first of all, just try and find a business that really has a compelling end application that's really providing a whole lot of value for business, because that just allows you to price and expand into different areas. I think also that old adage that, if you have a great manager meeting a bad business, it's the business reputation that survives. I think that can also run in the inverse. But to be fair, Bill McDermott's done a phenomenal job since he's been there. And I think, Owen, obviously the third most important lesson out of that experience is to make sure they listen more to my wife. So that's one that's always been, I wish I had it back then, but, maybe you get another chance at these things.
Yeah, that's a great business and a great way to, I guess, introduce you to the business as well, like to actually understand the use case from a real world application, that type of boots on the ground research, so to speak, or maybe it was just over the dinner table, is a real advantage for people that, particularly as we understand more technology companies going B2B, and maybe more technical for people. Speaking of, one question that I have for you is, I noticed that you studied engineering, and I often think, Charlie Munger's words about multidisciplinary learning, I often think that engineers are some of the most worldly, because you kind of you have different sciences in the back of your brain that you have to invoke, and you have to understand how the world works in order to construct things, build things, move things, do whatever. And I was wondering if you think that detail, that technical knowledge that you possess, or other people may possess if they study such a thing, provides an advantage when it comes to investing.
Yeah, look, I think it really has. So the main value isn't so much in terms of the technicalities that come through from the engineering, but it's just a way of really structuring your thinking. Just, being able to break down complex problems into manageable bites and then build it back up, and obviously getting that really heavy mathematical background as well. So for me, that's where the value came from, just in terms of that really structured and analytical approach to most issues that you come across. And obviously you can apply that quite directly in terms of many businesses have so many different elements to them that being able to break apart, just getting down to what the absolute key drivers are, because there can be a lot of noise that also washes through companies. being identify what's important, those key drivers, and then build that back up, I think has been quite valuable. But I think also just with that technical capability, I think what else you need is just a degree of flexible thinking and a bit of lateral thinking as well. So I'd recommend anyone, if they are looking at investing, I think accounting is absolutely critical, because the one thing that doesn't lie when you're looking at companies are the numbers, and being able to see the commentary from management actually flow through a P&L, balance sheet, cash flow, to make sure that narrative makes sense from what's coming out. And so that's critical. And then on top of that, just an ability to be a little bit flexible in terms of your thinking once you've actually done that analytical bedrock work, just to know that things can change over time and just be a bit adaptable as that new information emerges.
I've got one more question, which is more just around how you got started in investing. And then we're going to dive into the Alphinity investment process and philosophy and drill down into some businesses in the portfolio. How did you get started? Do you have anyone that was mentoring you or encouraging you to get into investing?
Oh, look, not really. Like, most of my family isn't really involved in investing. I had a father who ran a small business and a mother who worked in administration. So there wasn't really that natural hook there. But I guess all the way through school and even further is that you just had this overarching, just intense interest in terms of economics, and just the way that a couple of simple factors like demand and supply can just explain so much about how the world works, like from house prices to groceries to how much your football team is willing to pay for players. Those really basic demand and supply factors just explain so much of what we see in the world, and then that naturally converts its way across into investing. So when I first started my career, it was in group strategy and mergers and acquisitions within Commonwealth Bank, probably about 25 years ago. And through that, it was a very, very fertile time in terms of M&A. Every bank was running the ruler over each other, hoping the 4 pillars policy would fall. They were having a look at things like AMP, every regional bank, and then it kicked off all of the activity around wealth managers with, acquisitions for Colonial, BT, the works. It all happened. And in the background of that, Owen, you had a tech boom that was just going absolutely nuts. And so they're kind of your formative years where you're being grounded in that fundamental analysis, having a look at synergies, what companies can potentially acquire. But then on the side, just seeing a tech boom where, remember, people talking about multiples of eyeballs and things like that, and just getting that real initial test in terms of what you think a good fundamental investment is, anchored around the fundamentals, and just seeing that craziness go on. So that's kind of those formative experiences that you have. From that, it's just a fascination just being able to pull apart different businesses down to the key drivers and just really trying to determine what businesses have a really powerful position in the market and that you think will win over a multi-year time horizon. In terms of mentors, I worked when I moved into that equity side, not a massive name in the market, but I think he should be. I did a lot of work with Raz Buyan, who now is one of the principals at Wavestone. And he just taught that you've got to do the work in terms of a company. You've got to understand what is going on, because invariably you're going to get tested in terms of different noise and different shakes in that company. And if you don't actually understand what's going on, it's easy to be shaken out of it. Another one runs a business called Green Cave. David Pace was also very influential, just another phenomenal, hardworking, very, very sensible investor. And then obviously where I am now at Alphinity, I've been here for almost 4 years. Not just saying because I work here, Owen, but the people here are just phenomenal. Some of the smartest people that I've ever met, and just that end focus on the client never stops. And just there isn't that arrogance or hubris. It's just all about testing that new data point that comes in, seeing if it's correct, as opposed to just anchoring too heavily to a pre-existing conclusion. So just the flexibility of the thinking, the breadth of the thinking within Alphinity, I think, is the best that I've seen.
Yeah. I love that flashback to multiples of eyeballs for people that aren't familiar with that time in the investing world. I think that says it all. And what a time to kind of earn your stripes and to develop as an investor. So Alphinity's global fund, the funds that you work on, and there's not just the global fund, there's also a sustainable fund, if I'm not mistaken. It followed a very similar investment process and philosophy, and that's it's got like two competing or complementary maybe aspects to it. One is the quantitative methods that you use, and then there's the qualitative that kind of joins into it. which I'm hoping we can get into. But one of the things that kind of stands out through the investment literature that I've read is this idea of relative earnings surprises. Now, I'm hoping you can explain to us where that comes from, because there is a lot of literature on the website about that. Yeah. But I also just want to take this in whatever way it makes sense to you to describe how the philosophy process unfold and what you and your team are doing day to day. So however you want to do that, mate, like from the top down, bottom up, side to side, whatever you think.
Yep.
I think those are the key pillars. Like, how does that all come together?
Yeah, no, look, and that's an excellent question, because that goes to the heart of what Alphinity is. So it's just, I guess, underlying it is that fundamental belief that earnings drive share prices. And, every once in a while you will get periods of disconnect where the market does lose its mind. We saw it during, the tech wreck, multiples of eyeballs. We saw it a bit post-COVID, where capital became free and infinite. And some companies in that technology, particularly in that software space, just became a bit unhinged in terms of valuations. But it really is earnings drive share prices. And that's why we're focused on those businesses that can consistently beat market expectations, because all of our backtesting in terms of quant shows that if you can be in those companies that can beat earnings expectations, they tend to be serially correlated. So if a company beats once, it'll normally do it again. And on top of that, that's what really drives that share price outperformance. So that's a really key element. Then what else comes together with that is we've got three key elements. So it's those earnings surprises, or otherwise referred to as momentum. There's a quality component. So that's focusing in businesses generating strong ROEs, improving ROEs, generating good cash off the balance sheet. And then, of course, it all has to be bound by that third element, which is a reasonable valuation. And so the factors that I'm talking about, Owen, they're not rocket science, but they're just very, very basic factors that help you identify companies that you will be buying with the wind at your back. But that doesn't define the success. That quant process is the start more than the beginning. It kind of tilts the odds in your favor more to a 55-45 as opposed to a 50-50. But from there, the fundamental work has to begin. And this has been a process that was in place when Alphinity was founded by the domestic team around 15, 16 years ago, and has been consistently applied through the global team that's been running for 8 or 9 years now. And so we've just shown over time that when you back test it, these are the key factors that you look for in terms of a successful business.
So with a global investment universe, how do you pull that apart? Does it start with the quantitative lens and then the fundamental kind of follows that in?
Yeah, look, it can be both ways. So, we normally do a fairly extensive amount of travel, and so you're always meeting a whole range of companies. So it can either be from bottom up, or if you're looking for some new ideas, top down. So, I'd probably define our universe as being around 4,000 stocks. And so what's really powerful about the process is that because you run a co-PM model, it's a way of distilling down, this is what an Alphinity stock looks like. And we're all talking from the same page rather than everyone running off just chasing what might be their preferred area. So that's the key element about how it comes together, distilling that universe down from, say, potentially 4,000 stocks down to a tighter subset that are Alphinity stocks. Then we can do the detailed work. But like I said, it's more the start, and there's just a sensibility to the process where that it avoids, I think the real power of it avoids a couple of key things. So first of all, it avoids the more speculative companies that can really be a massive blow up. And I think that's an underappreciated element of being able to compound returns over time, just avoiding those stocks that are down 50, 60, 70%. So it's fantastic to find the winners. That's always a focus, but being in that quality end avoids the massive blow-ups. And then it also takes a lot of the emotion out of the sell decision, which I think is one of the more difficult things to do in investing. If you have a business that is starting to lag, it's drifting out of process, it just manages to take that emotion out of, hoping for the company to turn around. It's just a very easy next step just to cut that and reallocate the capital into other opportunities that are currently in front of you. Mm-hmm. And then, of course, that all comes together with the team structure as well. So we run a co-PM model. And so even though I have primary responsibility for tech, I'm not just there managing a discrete sleeve. It has to be a co-PM decision for anything to enter and exit the fund. And that's just a fantastic way to be able to harness the experience of everyone in the team. Because, you've got the co-founders, Jonas Palmquist, Jeff Thompson, they've all got more than 25 years experience. In the team, there's about 100 years worth of experience. So it's a way of making sure that you're fully harnessing all of that as opposed to just having, I guess, one kingmaker at the top making decisions and then other people within the team trying to desperately get attention. So it's the team structure and the process that comes together to just give you more sustainable compounding outcomes over time.
So that's interesting, the co-PM model. Can you, so if we take the process, we've got onto a company, we begin the DD, can you talk to us about like what is the actual mechanic there in terms of, do you all sit down in a room and debate the idea, or does one of you lead that? How does that actually, what does that actually look like?
Yeah, no, where it looks like, so for me personally, being the lead PM in terms of tech, if I'm finding an interesting business, it's normally a fairly iterative process where the stock will look like an Alphinity stock. We'll have a couple of portfolio meetings every week, and I'll start to discuss the merits, get the feedback from the team. And the good thing is in tech, Owen, is as you can imagine, everyone has an opinion. So I get a lot of feedback, which I find just incredibly valuable because I'm, being able to interact with some incredibly smart people every day. And then if you can get the team comfortable, normally go on what we call a best research ideas list, which is, it's almost like that bench, those next companies that can go into the portfolio. And from there, you are constantly doing that detailed coverage of the company, meeting them when you go on trips. And then if there is an opportunity in terms of that portfolio construction, say a company falls by the wayside or we want more exposure in that technology space, then it can move into the portfolio. But again, it's a team discussion the whole way through. I need to get the other people on board before I can have that move into the portfolio. So that's generally the way it works.
I actually did notice a lot of the literature and the commentary and the webinars, all the different things that you and the team do. It talks quite heavily, obviously, about that, the earnings surprise, and then the quant side. But then there's obviously the qualitative side of what you just mentioned, and bringing that to life. Those things like meetings and those types of things, which I do have a question about that in a minute. But how do you get comfortable with a company? I know that's a pretty general question, pretty high level, but do you go and seek out, like if it's a technical thing, like say ServiceNow or any type of business that maybe requires a bit more of that kind of upfront investment in terms of your time and effort, how do you begin that? What are the initial steps in the qualitative aspect?
Yeah, well, normally that's why we do a lot of travel, Owen. Like between the 4 PMs, we normally do about 4 trips a year. We've got a couple of analysts as well, and they do about the same. So you are looking at more than 30 investment trips a year, normally for 2 weeks at a time. And so I think that's the key way that you do it. Like the travel for international travel, it's not overly enjoyable, but it just has to be done to be able to get there. And I think the best way to describe it is that you have a look at a particular business and there is such an incredibly rich ecosystem that sits around it. And so there's so many different data points that you can help to validate your investment thesis. So I guess, if we take an example, a fairly modern example, something like NVIDIA, you can move all the way up the chain. You can have a look at who's actually taking their GPUs and putting them in a server. So you can talk to Dell, you can talk to CoreWeave, you can talk to Supermicro. You can go that next step further for where those servers are going and talk to all the cloud companies like your Azure, your AWS, your GCPs. And then that data center demand is driven by the end application. So then talking to, your ServiceNow in terms of what they're building, Salesforce, all the companies, Adobe for Firefly, and then all the companies that are using AI to generate those efficiencies. So you can go all the way up the chain, and then you can come back down the other way in terms of other companies that are feeding into what NVIDIA is making. So, TSMC that's doing their technology to go onto their board for the packaging. You can talk to the high bandwidth memory companies like SK Hynix, Micron, and Samsung, all the way down to the board makers. And so, there's no fewer, just off the top of my head, maybe 20 or 30 companies that you can talk to just validate what's happening in those demand environments. And then talking to all the competitive set that sits around it as well, like your AMDs, your Broadcoms. So there's never any end to the amount of data points or companies you can talk to help put together that overarching picture of the business. So that would generally how it is. It's normally kind of boots on the ground, going around, having these meetings and just trying to validate that initial investment thesis, which is quite powerful.
I love that idea of the value chain and moving up and down. I actually, just as fate would have it, I was just listening to Bloomberg 20 minutes ago, and they talk about how TSMC may be able to move some fabs or, plan some of those over in Germany, and talking about how it's not just picking up people and putting them over there with the know-how. You have to have an entire ecosystem that sits around that.
Yeah.
And that's one of the reasons why Germany, being, having the history that it does with like automotive and chips and that type of thing, that's why that makes sense. But a lot of investors don't think like that, right? We just think in this kind of vacuum of like, no, you just take the people and the equipment and you just take it over there, and then geopolitics solved. But it's not always.
Yeah, you're even seeing that at the moment, Owen. Like in terms of like I'd back TSMC to be able to get that done because they've got a very rich history in terms of being the leading edge foundry. But you have a look at a business like Intel that are trying to have their third crack at getting foundry going, and what you said is that's the very issue. It's not just about building the fab and the people; it's the entire ecosystem that sits around it that's incredibly hard to replicate. And so that's why some businesses, when you get to that position in the chain in terms of technology, you can build these dominant positions that can be quite robust and can last for quite a period of time.
I was asked by Mitchell in our team, he wanted to ask a question which was about your process and your framework. And because there are very distinct key points at which like a company becomes an Alphinity company, right?
Yes.
And he kind of inverted the logic of the question that I was going to ask. And he said, what part of the framework or philosophy or process or however you want to put it, could you absolutely not remove? Like the one thing that you think is like, now you don't have to give away all your secret sauce.
Yeah.
Is there a part of it that you think this is like gold? This is something maybe in your career, something that's new to the way I've done this previously, that's like changed the game.
Yeah, look, I think in terms of course, I'm going to say all three legs are very important. Like you can't get too unhinged in valuation. And if you're not focused on that quality, that's where you can get into those poorer quality businesses that can really punch a hole in you. But I'd have to say that key leg is around, and it was newish for me when I came into the business as well, is around those earnings surprises. Okay, that is absolutely key. Like I said, that fundamental belief that earnings drive share prices, and so that laser focus in terms of those businesses that are in an earnings upgrade cycle, I think that is the absolute key in terms of the Alphinity process and what sets it apart to some other investment processes. It might be happy to be in a business that is in a very heavy downgrade cycle. I guess I'd liken it to, catching the falling knife. Some companies, some investment firms that are more value focused are more than happy to go down that end, and you can make good gains that way. But with the Alphinity process, I think it chops off that tail of trying to catch a falling knife and that going very, very badly. So it might miss a bit of the early upside, but you just have greater certainty that when you are buying a stock, you are going to get that upside come through, as opposed to something just completely falling out of bed.
I like that. You mentioned going on the road and these types of things, especially for us Aussies. It's a long way to Europe or to the USA or even different parts of Asia. Right? It's a long way. And there's two kind of schools of thought about getting out, speaking to management teams and going to their presentations or investor days and what have you. Some say, it's pretty easy. They're quite charismatic. They can kind of lead you astray. And the other side is like, it's really valuable because you can create that mosaic quicker than someone else and put things together. I'm curious to know how you think about that at a high level, and some of maybe even if like how you go about speaking with management, how you go about assessing that aspect of the investing that you do.
Yeah, no, look, I think you're spot on. And if I'm being honest, I reckon, Owen, the biggest mistakes that I've made in investing is when you're seeing the data points line up, doesn't quite feel right. You talk to management, they give you a nice kind of comforting overarching story, and then invariably 6 to 12 months later, the whole thing comes apart. Yeah. So I think you are right that, the CEO is always going to be the greatest spokesman for the business, and you don't become CEO by accident. They're normally incredibly charismatic and can tell a fantastic story. I think where it is very useful is that you can listen to a CEO outline where they want the business to go and how they see the industry unfolding, which just gives a little bit more context to the numbers as they come through. But for me, it's just important to treat that information. It's just another data point to be interrogated along with everything else. You don't give it any more weight than some of the other data points that are coming through. So it's always treated with a degree of skepticism, but every once in a while, you'll just see something where a management team will just be able to step back and just articulate where they think the world is going. And then you can then validate those data points on the way through to making sure that what they said makes sense and they're on that track. Because another signal is obviously when you have a management team's talking about we're going to do X, and then all of a sudden 6 months later they're pivoting to Y. So you do want to see that continuity in terms of vision and execution play its way out. But yeah, spot on. You can never take it as gospel because you get very easily misled.
I liked how you, at the top of the show, you said that the technical knowledge that you've acquired is the ability to kind of see how the accounting, is playing out as well, because that tells its own story, right? It's like you said, income statement, balance sheet, cash flow. You can see the narrative play out or not in the case that you mentioned. Do you have any particular techniques that you use when you speak to management? Is there anything in particular, like maybe if there's two of you, one presents in a certain way? Is there anything in that regard, or is it more just letting management speak?
Yeah, I think what I've found over time is that, I know previously you used to go in with a very kind of detailed list in terms of these are the things I wanted to get out of it. But I think some of the more illuminating insights that you do get is when you actually just allow them space to talk. Because, you can get too hung up in terms of, what's going to happen with this quarter or what's going to happen with this next report. But what's fascinating is just allowing that space and following up on their questions to take them down a particular path about how they see that business evolving over time. So I think that's the main thing that I've learned over time. Don't get too hung up on the details. Allow them to articulate that vision, and then you can come back and then you can interrogate those, I guess, roadmaps that they've put through to make sure that the execution is actually on track and to make sure the business is heading in the direction that the numbers should indicate that it's heading towards.
I like that that idea, because like you said before, in the value chain, if you're like the technology lead, say, and you're looking at all these different businesses in GPUs, AI, that entire stack, let's say, you might be going to one meeting talking about, what's NVIDIA going to do? And you're talking to, say, IR or some expert in that field. But really, it's not them that you're looking at investing in. It's someone else that's adjacent to that. And so it doesn't really matter. You don't have to go in necessarily. And you can kind of just let them talk around the idea that you're really trying to build out with some more conviction.
Yeah, but at the same time, I would like that even those discussions can lead you, like yourself. That's what I mean. You've just got to allow your mind to wander sometimes. So another company that we had invested in was SK Hynix, and that came from that interrogation of the supply chain around NVIDIA, because they're the leaders in terms of high bandwidth memory. And so I was visiting with NVIDIA last year. You're holding their latest H100, and around the outside of their GPU, you can see all these little square boxes, which were the high bandwidth memory. And then NVIDIA is talking about how critical that is in terms of the development of their next generation of GPU systems that are coming out. And so that kind of throws you in a particular direction where, here's something adjacent to what I'm really interested in that is an incredibly interesting story that requires more follow-up. And we ended up having that in the fund for a period of time. So you've just got to just always maintain a relatively open mind in terms of what direction you can flow in.
I like that. And I like that visual example of holding a product in your hand and actually seeing what's on there.
Yeah.
Now, I know this is a big focus for you and the team at Alphinity, is thinking, about things other than just the financial aspects and more towards ESG, environmental, social governance. Is the kind of, it seems like a few years ago, it was the thing that everyone talked about. Now, maybe less so, but there's still that underlying demand from people who want investors to take this into account. I'm always interested in where this kind of fits in an investment process. So how you think about things beyond, obviously, the bottom line, how you and the team incorporate ESG principles or practices into your investment process.
Yeah, look, I think where we're quite lucky, Owen, is we have an incredible ESG team. And I'm not saying this because I'm at Alphinity. I think they're probably the best in the market. And so they are fully embedded in terms of our investment process. And it just comes from that basic belief that if companies are doing bad things, eventually there will be repercussions. Whether, if you're talking specifically in tech, if you're being too egregious, there's probably going to be some form of regulatory response. If you haven't got the right structures in place in terms of board, management can become a little bit unhinged. And of course, if you're doing bad things from a environmental perspective, eventually you will have, some form of regulation that sits around you. So that's the basic belief. So they are embedded whenever we're looking at investing in a stock. They will do a detailed ESG review in conjunction with the portfolio manager. And we have a rating system where, 1, the company is very, very clean. It's all fine. 2, it's still pretty good. 3, we need much greater scrutiny on it. And we might actually control the position size, given there is a little bit more ESG risk. And then that level 4 is that the governance just isn't good enough for us to be able to invest in. So there's probably like 2 really topical ones that we've been actively discussing recently, because this is always a fluid environment. Like, companies can change the way they operate. Sometimes they can get better, sometimes they can get worse. So it's not like the rating is set and that's it. But probably most topical ones are around Meta and around Tesla. So, Tesla for us is one of those on the do not invest list. And that's because the corporate governance that sits around it just doesn't give us comfort that the best decisions are always going to be made in relation to Tesla. And we saw that when Elon Musk took over Twitter and some of the engineers were getting sucked from Tesla across to Twitter. And that was at a time when, Tesla really needed to focus in terms of that development. So that's not a judgment on Elon Musk and some of the incredible things that he can create, but just that governance just gave us enough pause for concern that we couldn't invest there. The other one being Meta that we're actually debating again now, like has the treatment of data privacy, how they treat, I guess, social media impact on children, has that changed enough I can't imagine it being moved up to a level 2, but is it really still a do not invest? And, can it be moved up to a level 3? So they're just the considerations around, it's not so much a value statement as around these have real world financial implications if you do the wrong thing. Like, if Meta isn't shown to be clean in terms of how they treat data or protection of children, then more than likely you're going to get a fence put around you in terms of regulatory actions or some form of kind of business pull apart. So that's the lens that we do it in terms of the core global funds. For the sustainable funds, that's another level again, because they are sustainable funds. And so that's all about alignment to the UN Sustainable Development Goals. And so There's different goals for the SDGs, and you've got to show positive alignment with those goals to be able to make it into the sustainable fund. So there's about 70% crossover for the holdings, but it's just another level again to get into that sustainable fund, obviously.
Well, it makes sense to leverage what the team is already capable of in a different vehicle for people. I also like that idea, and I like how you bridge the gap between like the I guess the governance and the financials, and how those two things are not necessarily separate. They're actually joined and pretty strongly, and because that does eventually play out in the economics, like you see with companies like Amazon or Google or Microsoft in the 2000s. All these companies get questioned eventually about how strong they are, how powerful they are. Are they treating consumers right? Are they treating app developers correctly? In the case of Apple, these types of things, what implication does that have for society and so on? And those things all come into play when you think about making an investment. Yeah. I've got a couple of extra things on that in just a moment, but one final question, just more about the process is, I was curious to know how the team like self-assesses and reviews progress with both successful and unsuccessful investments. I'm just curious if you track unsuccessful investments or investments that say like ServiceNow, we could have made it, but we didn't. I'm just curious, do you have anything like that in place?
Yeah, look, I think that's the value of the PM model, is that there is always interrogation for what goes right, but I think more importantly, what goes wrong, because that is where you can really get your key learning from. You normally learn from the mistakes that you've made. And so that all comes down to, I think, the relationship that sits in the team as well. So you invite that interrogation. You'll normally if you've made a mistake, you'll normally be quite honest with the team and ask for their feedback. And the good thing is that with the team environment that we have here in the global team, that if people are pushing, if people are asking questions, it's all about getting the outcome, and it's not about, any form of, trying to make a point for the making a point sake. And so I think that's more of an intangible aspect, Owen, in terms of how it all comes together. You've almost got to have, I think they refer to it as psychological safety, where, people are going to make mistakes. It's the nature of what we do. We're going to always try and do the work to make sure that we get the majority right, but we are going to get things wrong. So with that, you need to be able to interrogate that mistake, see what we could have done differently, and if we could actually make sure that we don't make that mistake in the future. So, as a team, we're always discussing what we did right, but also more importantly, what we did wrong.
No, I like it. It's encourages self-reflection, and any investor should do that. A lot of times in teams and those types of environments, there's not a safe space to do it, and people kind of lose sight of the old footy cliche of focus on the ball, not the player. Yeah. And I think that rings true in investing many times over. There are a few topical areas that I want to get to, Trent, if we can. The first one that I've got is how difficult it is to beat the index right now. Obviously, Alphinity's track record is very good. But this is particularly interesting, I think, to ask you because of your technology focus. The indices now versus 20, or maybe not so 20, maybe say 30 or 50 years ago, the composition of major stock market indices has changed. Maybe not so much here in Australia, but definitely in the US and even globally. I'm curious to just get your thoughts on that, like how you go about beating an index that is technology heavy and does have these companies in it.
Yeah, look, It does come a bit tougher when the market does become more narrow. And you are right, Owen, in terms of the almost the complexion of the global markets has changed pretty materially. Like you never used to have to think about a big stock that you didn't own being big enough to, take some performance away if it really does go. But now you have a number of companies that are like that, and it's almost an active portfolio decision to not own any other potential, one of the bigger stocks. Something like an Apple, 4.5% in terms of the MSCI World. So to not own that shows up on risk reports in terms of you are taking an active call in terms of not owning that business. But I think you've also just got to be cognizant that the market does swing over time. And so you don't want to, I guess, chase that, that current theme and then end up with an unbalanced portfolio, because invariably things will always swing back. You've seen it in terms of companies that have led the market for years. It probably would have been almost inconceivable they wouldn't always lead, but there is always changes under the surface in terms of their composition. New leaders emerge and people lose that position of primacy. So for us, you just focus on the best companies you can possibly put together, but having that diversified portfolio that if you do get a big regime change is absolutely critical to make sure that you have got continuity of those returns, because you don't want to have a couple of good years and then you have, an absolute blowout year, because that's not how you compound long-term returns for investors.
No. The very first question was about a company that you didn't own, but you wish you did. And you said ServiceNow. I'm going to try and tease out maybe some other things that two companies out of your history, I've got in my notes here, that stand out as winners and what you learn from them. Just again, people say you learn a lot from your losers, but a lot of people say you also learn a heap from your winners. Yeah. And so I'm curious, if you were to kind of extract two of those companies from your time doing this, which is now quite extensive, what those two businesses would be and why.
Oh, look, I think the main one that comes to mind, Owen, is definitely Microsoft. So, I talked about companies losing primacy over time, but that is a business that has consistently just managed to reinvent itself and remain at the forefront in terms of that, I guess, that enterprise relationship. So you have a look at what's happened under Satya Nadella. First of all, the move to more of a subscription recurring revenue type model, whereas you used to have a whole lot of, I guess, lumpiness when people had to renew the licenses. So that subscription model is absolutely powerful. The pivot to the cloud was just, exceptional in terms of what they've done with Azure. And then they're at the forefront in terms of the shift to AI. So just being able to continue to pivot the business around what's emerging in terms of technology that could be a potential threat, but turn that into, I guess, a business advantage and just even more solidify their market position, I think has been absolutely incredible in terms of what they've done. And even with Teams, like there was a risk there for a while. You had things like, Slack. You also had Zoom that was starting to emerge. Like there was a risk that they were going to lose that dominant position in terms of being the communication interface within enterprises. And then along comes Teams, and they managed to kind of reinvent themselves again. So that is one that has managed to reinvent itself, and it's just been a really powerful long-term winner, and I think will continue to be for a while. The other one, I guess I'm kind of tying up two in my mind. So, of course, NVIDIA, the run that it has had, just being front and center in terms of the AI boom, has been exceptional. But I'd probably instead go with ASML. So I think, it's getting a lot more focused these days in terms of what the business does. But the fact that they have been able to build a monopoly position in terms of lithography, which is just the lasers to sketch out the design on a semiconductor. When it comes to those leading edge semiconductors being manufactured, they have a monopoly. They're the only business in the world that can do what's called extreme ultraviolet, and now they're moving to that next leg again called high NA. So a business that can generate a monopoly position in such a critical element of society around semiconductor manufacturing, I think is phenomenal, and you don't see that very often in any market. So that's probably the second one that I'd go with in terms of one that I've been very, very happy to hold for quite a period of time.
Does the Alphinity Global Fund, do you own either of those two businesses?
We own both.
Oh, right. Okay, great. Yeah.
Thankfully.
Yeah.
If not, I have to, end this discussion and then go explain to the team why we don't own them. So that worked out really well.
Yeah. My final question on this actual theme overall is, which of those big incumbent tech players, like I'm thinking FANG platforms, but you could extend that to whatever, however you think about this.
Yeah.
Do you think will keep winning? And or the counterpoint, if we go Charlie Munger, like which do you think maybe won't win? I'm really curious about this. There are a lot of opinions. Some people love or hate Apple. Some people love or hate Microsoft or Google, with AI, like so many different, I guess, aspects to it. And I'm just curious if you have any high level thoughts. If you don't, that's okay. But I'm just curious, given your position and what you do every day.
Yeah, look, I have so many. I'm not sure if I can, articulate them inside the next kind of half an hour, Owen, because it's obviously, I guess, going back to my point before, you almost need a little bit of imagination when it comes to these big businesses that are so dominant to imagine a time when they're not going to dominate. But you have a look back through time and it's happened. Like IBM used to be the biggest company in the world, let alone the biggest tech company. And so back then, the concept that IBM wouldn't basically own technology markets would have seemed almost inconceivable. Same with Cisco for a period of time. And then as you move to semiconductors, Intel was the only game in town. And now you roll forward, they've lost their technology leadership and the business appears to be in a degree of distress. And then even more broadly than those tech companies, like GE. GE was a business where an entire, I guess, industry sprung up around how you actually implement how GE operates its business. And so, these businesses, even though they absolutely dominate now, doesn't mean they'll absolutely dominate forever. I think ones that are probably more cemented. So I talked about Microsoft before and just being able to own that enterprise relationship and making sure you're at the forefront of the next technology shifts that come out. I think that has a degree of longevity. Apple's an interesting one. Like even you listen to the latest interview with Mark Zuckerberg through Acquired, and he really did lay out quite an interesting roadmap in terms of them wanting to own the platform so that they're not beholden to other people's constraints, whether that's, Apple with iOS or with Android. And then also just taking those first steps in terms of that new device state potentially being glasses. And so, the first iterations don't look great, but they're never going to be. But the fact that he does appear to have taken the lead in terms of that new device state is quite interesting and could potentially be a risk to Apple. I think the one that kind of vexes me the most, and we just discussed it again in our portfolio meeting, is Google. Because the foundation of their business is search, and already it feels like Google it, being a verb, is starting to lose some of its prominence. Like you talk to young kids today and they all go straight to ChatGPT. I'm using Perplexity a whole lot more. And so it feels like there is a little bit of a loosening in terms of search. The other risk being is that you're now facing these antitrust concerns, and it's almost got a bit of an echo with Microsoft in the late 90s to early 2000s, where you've got evolution happening in the industry and you're trying to respond, but you're doing so with one arm tied behind your back because you're fighting all these regulatory battles. So that's one that really I struggle with. But at the same time, Owen, like these guys have always led in terms of AI and have the richest data set out of probably any business on earth, where through your search, through Gmail, through YouTube, through all of the things that you do. You see what they're doing with Waymo, which I think is the ultimate test case in terms of AI. And when I go to San Fran now, my default is to get in an autonomous Waymo as opposed to catch an Uber. So they're in there. A couple of their researchers in DeepMind just won a Nobel Prize regarding isomorphic labs and how they actually map proteins. So they've got all of the talent to be dominating in this space, but historically they just haven't. They were late to cloud. They were late in terms of the shift to generative AI. And so that's one that is a real conundrum because the core business is getting some pressure in terms of search, but they've got all the skills in the world, but previously just haven't been able to execute to get to that monetization stage and dominate markets that they probably should. So that's the one that just ties me up in knots at the moment, Owen, that's trying to figure out, are they going to be the long-term winner or the loser? So yeah, I'd say Microsoft, fairly cemented. Apple's position in terms of that ecosystem is very, very strong. I think probably most at risk would be Google. And then Amazon's also a bit of a question because it's almost like, for me, I think the GFC was, well, not the GFC, sorry, COVID was probably the worst thing that happened to them because it made all of these legacy retailers really get their act together when it came to e-commerce. And so you're now seeing viable competitors just start to take a little bit around the edges, like a Walmart. We had Walmart through the office a couple of weeks ago, and the momentum they're now getting in terms of e-commerce is quite impressive. So that'd be another one where I think the foundations are maybe a little bit shakier. Interesting. Fascinating stuff, particularly the Google aspect. I think, yeah, I agree with basically everything you said there. I didn't know the Nobel Prize thing. That's fantastic. Yeah, that was just over the weekend. So like I said, like in terms of the AI capabilities, I think they lead, but just their ability, it's almost like they still haven't fully evolved out of that more kind of like university, research, trying to solve the world's greatest problems of humanity, and moved it more to a kind of a commercialized focus, which I think is what they need to do, especially considering that their core business is under pressure at the moment.
Yeah. Well, I guess it's one of those things where you might see weakness in the business because the core business maybe does falter, and then the narrative changes and you see those, the valuation come down, but maybe then to the Alphinity way, maybe you start to see earnings surprise and beat that, and then it re-rates, and then it does it again because one of those other things that they're working on is all of a sudden starting to pay off.
Yeah.
Now, there is a lot of great literature on the Alphinity website. There is going to be a link in the video and the podcast version of this discussion. So if you want to jump into the latest monthlies or even some of the webinars that you've done, they will all be in there. There was one recently on AI, for example. That's all great viewing and great literature. So for anyone that's interested, you can also look at the portfolio holdings and those types of things. It's all available there. Mate, I always end these discussions when someone's new to the show. I ask you for one thing that if you could go back in time and tell yourself, whether it's finance, investing, business, it could be literally anything, what would it be?
It's a really fascinating question. I think I'd probably say like just really embrace failure. Because I think, it's one thing that you get when you're meeting with a lot of these US companies in particular is that they don't shy away from failure. They'd more than happily try 20 different things, and if 18 of them or 19 of them don't come off, that's just a kind of a bit of a marker on the way to what they view as success. And so that's what I basically try and instill in my children more than anything. Like have a go at something. It doesn't matter if it doesn't come off, but I'd be much happier to see you have a go at something and it doesn't actually work than always think what if should I do this. And I even see that with, my brother obviously isn't investing markets, is a mechanic, opened his own shop, and I view him as being much more successful than what I am because he followed his own path, something that was great, really had a crack, and now has built something fairly remarkable. So that's what I'd say. If I could go back, I wanted to be, have a go at everything. Don't be afraid of failure. You can always backtrack if it doesn't work out, but just keep on trying different things and just embrace failure as just another marker and something that you can learn from on the way through.
I love that. You're the first person in the 6 or 7 years that I've been running this particular channel of our podcast that has ever said that. And I think that's just a wonderful thing. Maybe it's a bit of a lesson learned from having kids and a family. It's like telling them that it's okay to fail, and that's a journey of discovery. But I think that's wonderful. It applies to investing, life, business, like you said, literally everything. So
maybe I'm self-justifying all the mistakes that I've made. I need to embrace them.
yeah. Mistakes were made.
Yeah. My wife would say, the second leg would be make sure you learn from them. So there's a couple of legs to that.
No, well, this has been great, Trent. I'm glad that we got some time to sit down and talk about all things, investment process, go deep in that, and talk about these companies that are changing the world. So for more on that, I'm sure you'll get plenty of people follow up and visit the Alphinity website and learn more about you and the team. So, mate, once again, thanks for joining me.
No, thanks for having me on. Really appreciate it.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.